The Fed is going one way and the world's another. Could rate cuts spark more chaos than calm? This is Macro Matters, and we're talking about central banks. A rare shift is unfolding in global central banking. The Fed looks set to cut rates, just as others hit pause or pivot the other way. The ECB and Swiss National Bank are likely done easing, while Japan is edging rates higher. For the first time in years, the world's most important central bank is swimming against the tide. Choppy waters are ahead, but can markets stay afloat? Let's ask George Buckley, Chief European Economist at Nomura. So George, arguably the Fed is playing catch-up to other monetary authorities. Does that warrant the aggressive easing that markets are pricing in?
We think that the Fed will cut more aggressively now after what they said and did this week. They cut, of course, by a quarter point, but more importantly is that they told us that they were going to cut a couple of times more this year, which we've now built into our forecast. And we also think they'll go a few times next year as well. So we've got 3 more cuts in our view from next year. So quite a significant decline. 1.25% in our view, so a fairly significant fall in interest rates. And I think, to be honest, it's the economy which is also playing catch up, because if you look at what's happening to the unemployment levels and the unemployment rate there, that's weakening. It's getting worse, the jobs market. And I think that's going to be good enough reason for them to do what we think that they'll do, which is to ease policy fairly aggressively over the course of the next few months.
Well, George, I do have to ask the Fed independence question. Are the days of the US central bank acting with one voice over, or will Trump cede more dissent?
Obviously, Trump would like to see interest rates lower than where they are, which is obviously would be helpful to growth. But the Fed, it's important to preserve the independence, and I think also the Fed chair, if too partisan a choice was made over the Fed chair, there is a risk that other Fed governors might balk at that and not play ball, if you will. So I think that's also worth bearing in mind.
Will the markets feel the impact of policy divergence across the central banks, and will it complicate policy decisions?
I think there's nothing wrong with that going on. I mean, the fact that you've got central banks moving in different directions is a reflection of what's happening in those economies. Now, if it turns out that the weakness that we see in the US begins to seep into a more global protracted downturn, then it's only fair to think that other central banks will follow suit. We still think that the Bank of England, despite what they've said over recent months, will continue to cut interest rates. In fact, they've told us that they'll continue to cut interest rates. That's their plan. But it's getting a little bit more uncertain. That's certainly what Governor Bailey said. So it's perfectly reasonable that central banks can have different views and make different decisions, and they have done in the past and they will do in the future.
So George, let's look closer at the ECB. Many believe it's finished cutting, but could the political and fiscal mess in France spoil the central bank's perfect landing?
I think what France tells us is that there is only one major economy of the big economies in Europe that can loosen fiscal policy significantly, and that's Germany. When you look at all of the other countries, you've got France, which can't do anything because of its fiscal situation. You've got Italy, which wants to run primary surpluses. You've got Spain, which has no interest in increasing spending on defence. And you've got countries like the UK, where, of course, we're also in a bit of a fiscal pickle. So all of that means you've only really got Germany there to support the economy. And that could have repercussions for the ECB, in the sense that the economy might be hit more by tariffs in the near term than the longer term impact of, for example, fiscal loosening. We're quite constructive on Europe, though, particularly Germany, because of that fiscal loosening.
So finally, let's talk about the Bank of Japan. It's just unveiled its first ever plan to start offloading its massive ETF holdings. But couldn't this erode investor enthusiasm for policy normalization?
I don't think so, to be honest. And the reason for that is because what they've announced is something which is going to be in place for a very long time. I think at the pace they've suggested that they get rid of those assets would take about 100 years to get rid of them. So this is not a fast pace of reduction of the balance sheet. It's a very slow pace. I think what's going to be much more important are the data, which is upcoming, particularly the Tankan survey in the start of October, but also the fact that we've got the LDP election on the 4th of October, and that could have have a real repercussions for what the BOJ does. There is a risk of a move in interest rates, a higher interest rates on their October meeting, but we think on balance they'll wait until the January meeting before raising interest rates.
That was George Buckley from Nomura. Don't forget, you can watch more videos on Reuters.com.